Welcome everyone to our weekly webinar outlook for the new trading week ahead of us. My name is Ilian Yotov. I am the creator of the Quarters Theory and also the founder of allthingsforex.com and tradertape.com. The host of the popular daily All Things Forex broadcast as well. You can listen to my program, Daily Outlook on Major Currencies, 1 hour per day, every Monday through Friday, 8 a.m. to 9 a.m. Eastern Standard Time. Now, before we start the webinar, let me remind you that today's program is intended for educational and informational purposes only, and it should not be considered as giving any buy, sell, or hold recommendations. I'd like to thank our friends at fx3.com for putting together these series of webinars. And what we're going to do today is prepare for the top 10 spotlight economic events for the trading week, July 11 to July 15. Now, obviously, last week was a much busier trading week. We had two interest rate announcements, very important one from the Bank of England, the European Central Bank. European Central Bank decided to hike interest rates as everyone pretty much expected. We had the U.S. non-farm payrolls report, which was a dismal non-farm payrolls report. The U.S. economy only creating 18,000 jobs, which is much less than the consensus forecast, which we're expecting about 100,000. So, with the Fed's been waiting to see some significant improvement in the U.S. labor market. Unfortunately, however, that, in my opinion, is nowhere to be seen, at least in the last couple of weeks. So the next week ahead of us, I think that is going to bring us a sequence of important U.S. economic data that's going to provide some more clues as to what is really going on with the U.S. economy. Are things getting better or are they getting worse? If we take a look at the housing market, if we take a look at the labor market especially, things are not getting any better. Will other sectors, besides the jobs market, will other sectors of the U.S. economy show signs of improvement? That's going to be one of the main questions heading into the new trading week. Also, let's not forget that tomorrow we're going to see the start of the earnings season here in the United States. I believe Alcoa, one of the Dow components, is going to kickstart the earnings season, corporate earnings season, of course, for the second quarter of 2011. Why is that important for us currency traders? Because a lot of major currencies are influenced by the direction of the equities and stock markets. So positive earnings season obviously could cause stock markets to remain strong, strengthen equities, more investors' appetite for risk, provided, of course, there's no bad news from the Eurozone, because that's the main risk event at this point, is the debt crisis in the Eurozone. A lot of people still not convinced, including myself, not convinced that the worst is behind us as far as the European debt crisis is concerned. A lot of fear still on the market as far as the crisis spreading further from Greece going to other countries. Obviously, the two other bailed out nations, Portugal and Ireland. Some are saying, well, why shouldn't they now line up to get a second bailout as well? If Greece already got their second bailout, why shouldn't Portugal or Ireland later on ask for such? And now there's concerns that the crisis will spread into Spain and Italy and so forth. You know the scenario. So that could continue to weigh on the euro as well if there is more news and more investors' concerns about the debt crisis in the Eurozone. The first spotlight event that is going to kickstart the sequence of the top 10 events for us next week is going to come on Monday night, early Tuesday morning, around midnight, but it could be a couple hours earlier, could be a couple hours later. Many of you probably know that the Bank of Japan does not really officially announce the time for when they're going to make the announcement on their interest rate decision. This, obviously, when a major central bank announces an interest rate decision or has a monetary policy meeting, it's an important event, but I'm not quite sure whether the Bank of Japan's interest rate announcement will have the potential to move the markets a whole lot. The Bank of Japan more than likely is going to confirm the market's expectations that they're are going to stay as the last central bank in line, so considering kind of tightening anytime soon. After the devastating earthquake and tsunami, that's one of the reasons, of course, why the Japanese economy is not doing as well. They're still trying to recover from that devastating impact of these disasters. And on top of that, in the first quarter of 2011, Japan had another quarter of contraction. So that makes the fourth quarter and the fourth quarter of 2010, of course, in the first quarter of 2011, two consecutive quarters of economic contraction. What does that mean? Well, that's the basic definition of recession. So Japan, the Japanese economy, registered officially its third recession in a decade. So with that type of economic environment, it's very hard to see the Bank of Japan actually considering any type of tightening monetary policies. Moreover, they could possibly consider more stimulus if the economy gets to slow down additionally. So I'm not expecting any changes, however, to the current monetary policy. And unfortunately, nothing really interesting has been taking place when it comes to the dollar versus the Japanese yen currency pair. I have the short-term daily chart of the dollar-yen currency pair for you. And in recent webinar sessions, we have been drawing this channel here that the dollar-yen pair has been stuck within pretty much since the beginning of the month of May. What's the bottom of the channel? Well, it is the low at 79.56. And as the top of the channel served the highs at 82.23 yen. So this is a channel that also, as I explained previously, falls within the majority of this channel, falls within the range of an important, what I call in my quarters theory, large quarter, between two major large quarter point, which is a major whole number at 80 yen, and a large quarter point above, which is 82.50 yen level. So for the most part, the channel that the dollar-yen currency pair is stuck within since May is almost the large quarter, between 80 and 82.50 yen. The dollar-yen pair attempted to challenge and approach the bottom of the channel recently here about 3 weeks ago. It didn't break below the bottom of the channel at 79.56 yen. It stayed at 79.70, wasn't it? That was the low there from June the 8th. Then it started heading slowly but surely towards the top of the channel. There was some resistance here around 81 yen level, 81.05 in particular. That level was broken above last week. On Thursday and Friday, we actually saw the dollar-yen pair managing to advance a little bit farther to 81.41, then 81.47 on Friday. But it very quickly sold off again, and you can see that sharp move lower after the payrolls came out, the dismal payrolls and so forth. Risk aversion, the markets turned around, and the dollar obviously does not tend to do very well when there's strong risk aversion in the markets. The Japanese yen, perceived as a so-called safe haven currency, even safer than the U.S. dollar, benefited from that risk aversion on Friday and from the negative U.S. economic data with the non-farm payrolls coming out much worse than forecast. So the dollar-yen currency pair is still confined within this range. Right now you can see it's more than obvious prices are in the middle of the range. To me personally, when a currency pair is stuck within a range, and it's in the middle of the range, that's not the type of price point where my interest is being sparked. In a range-bound environment, opportunities should be looked for either close to the bottom of a range or close to the top of a range. And obviously at this point, we're right in the middle of the range. So nothing really that exciting. I'm not seeing next week, I never say never, right? I mean, if we get to see some terrible news coming from the Eurozone that causes some massive risk aversion, which is, let's say, similar to what we've witnessed 3 years ago in 2008, I mean, obviously, at that point, the dollar could really break below the bottom of this existing range. But unless that happens, the dollar-yen currency pair could easily stay confined within this range. It's been a very slow progression from the bottom of the range, a little bit above 81 and then to 81.5 approximately in the recent couple of days. Now we're back to 80.5 area. We could possibly test the 80 yen level, which is the major large quarter point there, an important level in my quarters theory. We could test these previous support levels, and if we break them, obviously there could be further losses for the dollar against the yen. If the dollar, however, stays above the bottom of this channel, we could still anticipate that there might be a move higher. Not very exciting. It's a tight channel. It's a couple of hundred pips of a channel, even less than a couple of hundred pips, actually. Well, it's a little bit more than a couple of hundred pips, but it's not a very large channel, and we'll see what happens next week. We could see it very easily. We could see the dollar-yen currency pair confined within this range. The next spotlight event for us, heading into Tuesday's trading session, is going to be one of the most important events next week. And we already have two questions. One of them is from Anita. She's asking what's my forecast on the euro versus the US dollar. We'll definitely discuss this major currency pair, Anita. Give me a few more minutes. And then, of course, John from Canada. Hi, John. Good to hear from you. Thanks for attending today as well. He always asks for the Australian and the Kiwi, what's my outlook for the upcoming week on the Aussie and the Kiwi. We'll touch on that because one of the spotlight events that's coming up next week is not directly coming from Australia, but it's going to be an important event for both of these currencies, the Australian and the New Zealand dollar. So thank you guys for the great questions. Thanks for attending the webinar today. I will answer them in a few minutes. But before I do that, let me discuss the number 2 top 10 event for next week, which is one of the most important ones in my opinion, which is going to come from the United Kingdom with the Consumer Price Index there. This is the preferred gauge of inflation by the Bank of England, and we know that inflationary pressures have been very stubbornly high and remain stubbornly high, and have caused a lot of market expectations to be priced in, at least before the summer came. That in last quarter we were seeing a lot of experts forecasting that the Bank of England is going to start hiking interest rates, possibly as early as May. Well, that was not the case. And it seems like the rising inflation in the United Kingdom, which I agree, it's very, very high, 4.5% in a month of May. And by the way, for the Tuesday's report, the consensus forecast is for the same reading, 4.5% year-over-year inflation in the United Kingdom. That is way above the 3% ceiling, above which the Bank of England does not like to see inflation. It is also more than twice as much as the preferred inflation level, which is about around 2%, is where most central banks like to keep inflation at or around 2%. So at 4.5%, we're very, very high as far as inflation is concerned. But rising inflationary pressures have proven not to be enough of a factor to prompt the Bank of England to hike rates. Why? Because for months here, like a broken record, I've been repeating, rising inflation is not enough. Rising inflation is not enough. It's not enough. It's not enough. You have to have another factor and another requirement being met. So those of you who listen to this program on a regular basis know what that requirement is. That requirement is that we have to see the United Kingdom's economy also showing signs of resilience and strength. The reason why we have to see that is because rising inflation would not be enough to prompt the Bank of England to hike interest rates in an environment where the economy is turning around and is slowing down, and it's there's a possibility of even a recession. So We know that the UK government has not helped a whole lot with the strengthening of economic activity in the UK because they're already undertaking the most aggressive spending cuts and debt reduction measures since World War II. So no surprises there that the UK economy is not very strong. Worldwide economies, I mean, there is a slowdown around the world. It's not the UK economy. But we've discussed for months here that the Bank of England policymakers are not going to be very comfortable hiking interest rates when the economy is slowing. And that is why a lot of these market expectations have been that the Bank of England will raise rates have been pushed much forward, and the market is now not even pricing in that the Bank of England will actually raise rates in 2011, this year. A lot of major financial institutions and economists and currency strategists there have come out and have said that they're pushing their forecasts for the first quarter, maybe even the second quarter of 2011, that the Bank of England will hike rates. So with these expectations being priced in, yes, the British pound could find some bidders, in my opinion, on expectations that inflationary pressures will remain elevated. That's the forecast. The market's expecting that. The pound could stay supported. The big question, however, is what happens after this consumer price index report? Because in recent days, and let me switch us over to the daily chart of the pound versus the US dollar currency pair. And Anita says, yes, but the Bank of England will stop the QE program, quantitative easing. Yes, they have already contained their asset purchase program, which is their quantitative easing program. It's been contained to 200 billion pounds since I believe that the third or fourth quarter of 2009, so it's been almost 2 years since the last time they increased the size of asset purchases. But if you paid attention to the minutes report, and that really hurt the British pound as well a couple of weeks ago, if you remember, we had the Bank of England issuing the minutes report from their monetary policy meeting in May. Or was it in June, rather? And we saw with the minutes, the vote was changed. The vote before was voting three policymakers out of 9 voting for an interest rate hike, 6 of them voting against it. Now the vote changed to 2 voting for an interest rate hike, 7 voting against the hike, and there were some policymakers there that even called for an expansion of the asset purchase program. So that discussion that there may be a possible expansion of the asset purchase program, especially if the economy continues to deteriorate and slow down in the United Kingdom, that door is open, in my opinion, for further expansion of the asset purchase program. And that would, anyone who's paid attention to the British pound in 2009, 2008, when the Bank of England undertook these expansions, especially in 2009, when the Bank of England was raising the ceiling on that asset purchase program, it was very detrimental for the British pound strength. I mean, a lot of currencies, including the euro, rallied very strongly versus the US dollar, whereas the British pound was a major underperformer, and it was due to the Bank of England raising that ceiling. So if that discussion is back on the table, I think that for more quantitative easing, then that could be a major factor that could cause British pound weakness. And it shouldn't be surprising that, as we discussed, by the way, on this program as well, the pound-dollar exchange rate has been trading within this range between 59.37, serving as the bottom of the range right here, and approximately the large quarter point there at $1.6750, with the high at $1.6745, serving as the top of the range. And that's been the range since February of this year. Pound-dollar pair exchange rate has been fluctuating within that 800 pips approximately range. So it wasn't surprising to see after the minutes report the British pound really coming under pressure, breaking below the $1.60 major large quarter point and testing the bottom of that range at the $1.5937 and establishing a recent new support level at the $1.5911. And right this point right there where my cursor is, you will see that was the low from June 29th. So that was the attempt for a breakout, bearish breakout below the bottom of the range. Of course, on the very first attempts, and I explained that in my book as well, on the first attempts, it's not very usual. As a matter of fact, in most instances, on the first attempt, when you have a strong support level, such as the bottom of the range for a number of months, we may not see prices breaking below these levels decisively on the first attempt. But that doesn't mean that if these scenarios I was explaining earlier, if the market continues to price in, or rather to unprice the expectations that the Bank of England will hike rates sooner rather than later, and we continue to see weakness in the United Kingdom's economy. Those are going to be the two major factors, and let me add a third one as well, which is, of course, more risk aversion that could obviously also weigh on the British pound. Those are going to be the three major factors that could serve as catalysts for further British pound weakness and a breakout below that bottom of the range at the $1.5937 and below the new support at the $1.5911, which will open the door for a completion of the large quarter between $1.60 and the large quarter point below at the $1.5750. And let's not forget that you had a support level there, which I'm sure was not a coincidence. If you're familiar with my quarters theory, you will see where my cursor is over there, all the way to the left side of the chart. The low there on January 25th was $1.5751. So that's your next support level there. To me, of course, not a coincidence that the large quarter point at the $1.5750 served as a support level at that time in January of this year when the pound was dropping towards it. So a decisive breakout below these support levels, below the bottom of this range, could really open the door, and the pound very quickly could fall to the large quarter point at the $1.5750. Now, that's going to be a very bearish scenario for the pound against the U.S. dollar. If the pound remains supported on rising inflationary pressures and what could be a little bit more positive report on Wednesday morning, again, another spotlight event from the United Kingdom is going to bring us the jobless claims and unemployment rate, which is an important, two important gauges of labor market conditions in the UK. By the way, the consensus forecasts are expecting a little bit of a lesser amount of people filing for first-time unemployment benefits, and we shall see whether that is the outcome. The forecast is for an increase of 15,100 new claims in the month of May. This is compared with April number, which was 19,600. So as you can see, about 4,000 less people filing for unemployment benefits. The unemployment rate is expected to remain unchanged at 7.7% in the United Kingdom, with the report on Wednesday morning at 4:30. So you have the CPI report, the inflation report on Tuesday that could show inflation pressures elevated. And then on Wednesday, if the employment report is positive, that could help these couple of reports. If inflation is rising, if the labor market's doing okay, I'm not expecting any impressive numbers, but if it's doing okay, maybe the pound could find some bidders and remain supported. As I mentioned earlier, however, what happens after that? And what happens not only after the reports are over with, but what happens if these reports are worse than what the market's expecting? If the labor market report especially is worse, and what happens if the inflation is not rising as much as the market may be forecasting? then that could really turn things into more negative, into that bearish scenario for the British pound, where we get to the pound breaking below these support levels, the bottom of the channel, and moving to $1.5750 area. If the pound does not do that, obviously it will stay within this range, and if it stays above the bottom of the range, we could see it actually inching a little bit higher next week. So I'm expecting the pound to be supported ahead of these reports, especially ahead of the CPI report. But be careful. A lot of times you get to see buy on the rumor, sell on the actual fact, and things turn around very quick. So we'll see whether that's going to be next week with the pound-dollar exchange rate. The other important spotlight event on Tuesday is going to come from the United States with the Federal Open Market Committee meeting minutes, which is going to be the minutes from the previous Fed's meeting. I'm not expecting this to be that big of an event because the market already knows where the Fed is as far as monetary policy, but it could serve, the minutes report, I think, could serve as a reminder, if you will, that the Fed is in absolutely no hurry to start hiking interest rates or tighten monetary policy anytime soon. And the Fed, with the last statement, the Fed said that the recovery was, quote, frustratingly slow. So I'm expecting the minutes report on Tuesday from the Fed's meeting to echo that sentiment, that the recovery is frustratingly slow, the Fed is going to keep rates exceptionally low for an extended period. End of quote. That's the exact quote from the Fed that we've been hearing for a number of months as the Fed continues to keep rates at record low levels. And then on Tuesday night, a big report's coming out from China with the gross domestic product, which is the main measure of economic activity and growth, and China is the world's fastest growing economy. However, the Chinese government and Chinese authorities and the People's Bank of China, which is the Chinese central bank, recently raised interest rates once again because inflation came above 6%. There's even a perception among some experts that China has really lost control over inflation and that they're way behind the curve as far as containing inflationary pressures, that some feel that they might be getting out of hand. Well, certainly the actions of their central bank continuously hiking interest rates and implementing new reserve requirements for Chinese financial institutions and so forth certainly point to that view and confirm that view, in my opinion. Chinese authorities are now scrambling to keep inflation in check and to cool things off with the Chinese economy. So why is that important for us currency traders? If China slows down, then we know that the two most impacted currencies by a Chinese economic slowdown would be the currencies down under, because China is their largest trading partner. China is the largest trading partner of Australia and the second largest trading partner of New Zealand. So obviously, if China slows down, then that could slow the demand and reduce the demand for raw material exports, which both of these nations, Australia and New Zealand, are exporting nations. They export raw materials, commodities. So Chinese demand is strong Chinese demand is very important for economic growth in both New Zealand and especially in Australia. So the Chinese government's efforts to cool things off and to slow things down could actually, we could see the effects of that, of their efforts. With the GDP numbers, we're expecting a reading on Tuesday night at 10 p.m. Eastern Time of 9.5% quarter over year, which means at this quarter last year, we're seeing 9.5% economic growth compared with the same quarter last year. That would be, however, a little bit of a lower reading from a previous reading of 9.7%. So you can see things are slowing down. Not dramatically, obviously, but we're seeing a little bit of a slowdown there. So if the slowdown is even larger than the forecast number, which is 9.5%, if we get a lower reading, then the Australian dollar, in my opinion, could continue to lag momentum. When I say the Australian dollar was lagging momentum, all one has to do is take a look at what happened on Friday. Because here we had a resistance level at the $0.0789, or was it 80? Yeah, $0.0789. The Australian dollar reaches as high on Friday as a $0.0787, but failed to produce a breakout above that resistance. And if it continues to do so, and if China continues to show signs of a slowdown, that bullish momentum for the Australian dollar in the last couple of weeks, you see here in the last couple of weeks, the Australian dollar has been bouncing off of what used to be a bottom of a channel here around $1.04 versus the US dollar. It managed to move to target these resistance areas. Of course, it completed the quarter between $1.05, $0.0750 large quarter point. Above $0.0750, it had $0.0774 being a previous resistance. We overshot it recently on that rally. The Australian dollar established a new resistance at $0.0789, and it failed to break above it on the attempt last Friday. So, if the Australian dollar continues to lag that momentum to produce a bullish breakout above resistance at the $0.0789, we could see a very important development that could give us the hints as to what the next move for the Aussie might be. I explained that in my book, in my version of the classic Elliott wave theory, in a concept that I call a trend wave failure. See here, during the strengthening of the Australian dollar, if this were the first bullish trend wave, which it was, breaking above previous resistance levels, previous highs, I call this a reversal trigger wave because it could start a reversal from that bearish sequence. We had a bearish sequence here that moved the Australian dollar towards the bottom of the range around $0.04. Then we had a reversal trigger bullish wave that reached new highs at the $0.0789. So a little bit of a pullback here, a little price correction after the first bullish wave, and then a second bullish wave started last Thursday and Friday. Problem is, however, that the only way that the second bullish wave will become successful is if the highs of the first bullish wave are broken. It's not rocket science, it's the basic definition of an uptrend, higher highs. If the second bullish wave does not produce higher highs than the first bullish wave, then we have a problem. That could be the first sign if the Australian dollar continues to do that, and as I said earlier, lack that upward bullish momentum, and we do not see a breakout above the high of the first bullish wave at $0.0789, then that could be a signal of a potential trend wave failure. I explained the concept of trend wave failure in my book, The Quarter Series. And I also explained the main consequence of a trend wave failure, which is the development of a, what I call, reversal trigger wave in the opposite direction. So if a bullish trend wave were to fail, as we're starting to see the possible warning signs of that since last Friday, if the second bullish wave fails, then we can prepare for the development of a reversal trigger bearish wave in the opposite direction, which is going to target these lows at the $0.0653, break below them, and the Australian dollar more than likely will drop to the large quarter point at the $1.05, and maybe even lower to the bottom of this existing range, which is approximately the $1.04 level. The low here was $0.0391, just a little bit of an overshoot below $1.04. So that's the bearish scenario for the Aussie. If, however, the Australian dollar does find, let's say we have strong appetite for risk, of course, positive earnings season could help. If China is growing stronger, with the report on Tuesday that shows us that, or at least It's not slowing down significantly. If we get to strong risk appetite, if there's no bad news from the Eurozone with investors' concerns about contagion and so forth, the bullish scenario for the Aussie would be a breakout above that resistance, which now is a double top, by the way, resistance. The initial reaction to a double top, we shouldn't be surprised as they move in the opposite direction. But that doesn't mean if the Australian dollar musters the strength to continue to test this level, which is the double top resistance at the $0.0789, that we're not going to see a breakout. A breakout is possible, but the Australian dollar is going to need a catalyst to propel it higher. And only stronger data from China and also strong risk appetite and positive investor sentiment next week could be that catalyst for the Aussie. If these factors are missing next week, then we could see the bear scenario playing out. The bullish scenario, of course, would be a breakout above the resistance, which will open the door to at least a move to that resistance level. Of course, it will open the door to the next large quarter between $0.0750 and the major large quarter point at the $1.10, which of course many of you know served as a major level of resistance there. New record highs were established in May for the Aussie versus the US dollar at $1.1011, which was 11/5 of an overshoot above the major large quarter point at the $1.10. So the bullish scenario, a breakout above this resistance would open the door for the Aussie dollar pair to move into this quarter between $0.0750 and $1.10. Within the range of this quarter, an important resistance level is the high from May the 12th, which is $0.0888. $0.0888, which is halfway through the actual quarter between $0.0750 and $1.10. So that's a resistance level that could be encountered. But a bullish breakout here could at least move prices to that resistance level, if not even, and if that level, of course, is broken above, then we can even see the completion of the quarter towards the $1.10. So these are the two scenarios heading into the trading sessions of next week when it comes to the Aussie dollar exchange rate. And the Kiwi dollar is, the Australian dollar is lacking that strong upward momentum, but the New Zealand dollar is not. And the New Zealand dollar in recent months has actually become the preferred alternative, if you will, for higher yield seekers. How I like my sequence and choice of words here. Higher yield seekers have chosen the New Zealand dollar in recent months over the Australian dollar. And we're even seeing and witnessing here in recent days new record highs that are being established for the Kiwi US dollar exchange rate at 0.8384 on Friday. That's the new high that should be watched. That's a decisive breakout above previous record highs at 0.8330 area. That area has been now broken above. And many of you who listen to me on a regular basis know my rule of thumb is that we should not disregard the fact that we have a long-term record high major resistance level breakout. A bullish breakout above previous record highs could open the door to hundreds of more pips of gains for the Kiwi against the US dollar. It is a open game here because historically these are record highs, never before reached levels. And this is really an open road, if you will, ahead for the Kiwi against the US dollar. After a bullish breakout, a decisive bullish breakout, that means possibly hundreds of pips. Where to next? 84 cents, 85 cents is the next large quarter point. Those are a couple of important price levels that you might want to pay attention to in the days ahead, because I cannot tell you how many hundreds of pips. Could be 100, could be 200, could be 1,000. No one can tell, but my rule of thumb is that when we have such decisive breakouts above previous record highs or below previous record lows, that opens the door to hundreds of pips of losses. All you have to do is check out previous record highs for the Kiwi. When they were broken, there were hundreds of pips. Take a look at the Australian dollar. Did the same thing. Previous new record highs were around the parity level, 1 for 1. Then we found it 10 cents higher, 1,000 pips higher at the $1.10, establishing new record highs. Have you? Do I need to give you more examples? Let me give you a bearish breakout example. How about the euro against the Swiss franc? Did you remember previous record lows for the euro versus the Swiss franc were 1.24? 1.24 Swiss francs for 1 euro. 600 pips lower, the euro-Swiss exchange rate established a new record low recently at the dollar a little bit above 1.18 Swiss francs for 1 euro. 600 pips below the previous record low. So I can't really tell you, will it be 600 or 1,000 or just 100 pips? Can't tell you that, but I feel that there may be further gains for the New Zealand dollar versus the US dollar, especially if we get to see improvement in investor sentiment. Of course, if investor sentiment sours and we get to see bad news from the Eurozone with the debt crisis there and fears of contagion, that scenario will be out the window. So let's move along and take a look at our next major spotlight event. After the Chinese GDP report, we'll see the United Kingdom's jobless claims on Wednesday morning. I already explained the potential impact of that report and the outcome of that report. That's going to lead us to Thursday's report from the Eurozone, which is going to bring us the harmonized index of consumer prices, the main measure of inflation preferred by the European Central Bank. This is, by the way, a report where we already had a preliminary estimate showing us that the inflation was at 2.7% in the last couple of months, May and June, in the Eurozone. That is above the 2% comfort level. The European Central Bank's main role is to control and assure price stability, to control inflation. That is why the European Central Bank has decided this year twice to hike interest rates by 25 basis points. We witnessed on Thursday of last week the European Central Bank raising rates another 25 basis points. Now the benchmark rate in the Eurozone is 1.5%, 1.5%. But this, in my opinion, was already priced into the euro-dollar exchange rate. And now, although we saw the euro actually rallying as a result of a dismal non-farm payrolls report from the United States, which was, as I mentioned earlier, much, much worse than expected, then when the markets turned around and we got a sell-off in equities, the euro came under pressure once again. So it was a bit of a roller coaster ride, and all I have to do is, this is the daily chart, but let me just show you the 60-minute chart of the euro-dollar pair. This is the trading session on Friday. Move lower, general direction of the intraday trend obviously was lower. Sharp spike higher immediately after the non-farm payrolls report, and then in the hours to follow, the euro began trailing lower again and continued to test an important support area, which was $1.4220. That was the low from Thursday, and on Friday we had a low at $1.4212. So we overshot a little bit lower. And now with the new trading session today, we're even seeing the euro inching a little bit lower to $1.4201 intraday low so far today. What does that mean? Well, if the euro continues to progress lower, that means that we could see it testing these previous support levels of the smaller channel within the bottom of the smaller channel within the larger channel. What do I mean by that? Well, I explained in the last several weeks. There's a larger channel here in the last 2 months that the euro-dollar exchange rate has established. The bottom of the larger channel is the lows a little bit below $1.40 at the $1.3969. The top of the larger channel is approximately the $1.47 level with the double top resistance here at the $1.4696. So the euro-dollar exchange rate has been fluctuating within that channel for the last 2 months, since the beginning of May. But in recent several weeks, there has been a little bit of a smaller channel now that has been established within that larger channel. And the smaller channel was between $40.73, the low from June 16th, and the top of the channel was approximately the large quarter point, important level in my quarters theory, with previous highs at the $44.97 and a $45.20, which is approximately $1.45 level. Now the euro managed to not break below the bottom of this channel. It moved lower, but it established support a little bit above $1.41. So it stayed above the bottom of the channel at the $40.73. And it staged a nice little rally last week, the week before last week, where the euro moved from as low as $41.02 to as high as $1.45. What was it? $45.77 on July 4th, which was a little bit higher, obviously, than the top of this channel. Unfortunately for the euro, however, throughout this week, the euro has reversed again, falling within that previous channel again, and now on its way towards the bottom of the channel. So if the euro continues to drop below $1.42, we could see these previous lows around $1.41 being targeted, and especially important is going to be the two lows at the $41.02 and the bottom of the smaller channel at the $40.73. That's your bearish scenario. A break below the bottom of this channel could move us very quickly to the bottom of the larger 2-month, 3-month channel. On the other hand, if the euro continues to stay above $1.41 area in general, we could see it back towards $1.45. I wish that I could tell you the exact direction of the euro next week, but I don't think that that's going to be very easy. Obviously, opportunities could be looked for either at the bottom or the top of the smaller channel, but at this point we're sort of not exactly in the middle, but close to the middle of that channel and close to the large quarter point at $42.50. So generally speaking, it's a coin toss, in my opinion, when it comes to trend developments. The reason I'm saying it's a coin toss because there is no trend. That's the problem. The euro's been range bound for the last 2 months. It's trading in a range, and I'm not saying that there aren't any opportunities when you have a range bound currency pair. There's plenty of opportunities, but to me, my interest I get more intrigued, if you will, either at bottom of existing channels or tops of existing channels. In the middle range, I'm not that interested. So it's a bit of a coin toss at this point, and the only helpful hint could be the 3 factors I mentioned earlier. Risk appetite, investor sentiment, economic data. I mean, everybody knows the inflation in the Eurozone is above the the European Central Bank's target. So the Thursday's report is not going to be that much of a news. What's going to be important, however, is any kind of news that comes from Greece or the Eurozone in general. As I mentioned in the beginning of the webinar, many traders continue to be unconvinced, and investors as well continue to be unconvinced that the worst is behind. So that could continue to weigh, obviously, on the euro. That uncertainty, that pessimism, the fears that the European debt crisis will spread and it's far from over, could be major risk factors for the euro. What could be euro positive? Investor sentiment improving, positive earnings season, first week of earnings season here in the U.S., which starts tomorrow. More positive economic data from around the world, including here in the United States, because negative U.S. economic data obviously means the Fed could continue to stay accommodative. You know, that could hurt the U.S. dollar. On the other hand, more positive U.S. economic data could start helping the U.S. dollar as the market starts expecting that if the U.S. economy has a significant improvement, maybe the Fed is going to act and consider tightening sooner rather than later. So those are several factors there that one really needs to pay close attention to. But when it comes to trends, to me, the euro is completely trendless in the last couple of months. It's simply trading within a range. So the next major spotlight event for us next week after the European Central Bank preferred gauge of inflation, the Harmonized Index of Consumer Prices, on Thursday morning we're going to see probably the most important spotlight event next week, which is the U.S. retail sales. It's an important gauge of consumer spending. The consumer spending is 2/3 of the United States economy, so obviously very, very important for the U.S. economic recovery. Now, the retail sales, according to the consensus forecast, are expected to show a reading of 0.3% month-over-month increase, which would be a positive report. 0.3% month-over-month increase in June will manage to recover from the 0.2% month-over-month drop in May. So retail sales dropped by 0.2%, and we could see them higher next Thursday with 0.3% consensus forecast. Now, this retail sales report on Thursday could start what I would call a cautiously optimistic sequence of U.S. economic data. Now, why would I say that? Because the retail sales are going to be followed on Friday by three other important events from the United States: the Consumer Price Index, the industrial production, and also the U.S. consumer sentiment. And all these four reports, the retail sales, Consumer Price Index, industrial production, and consumer sentiment, are expected to have a positive tone. The Consumer Price Index on Friday, I already said the retail sales could be better in June than they were in May. Consumer Price Index is expected to show that inflationary pressures in the United States remain subdued. Subdued inflationary pressures mean Federal Reserve in no hurry to start tightening anytime soon. More gravy, more stimulus for the markets and for the economy. The industrial production, which also is due on Friday morning, is expected to increase. U.S. industrial activity is expected to increase by 0.4% month over month in June, which would be up from 0.1% in May. And the U.S. consumer sentiment is also, this is the preliminary estimate for the consumer sentiment in July. A revised estimate will be reported 2 weeks after next Friday. But the preliminary estimate, at least, the consensus forecasts are pointing to an increase in consumer sentiment to 72.5 in July from 71.5 in June. So that's why I'm saying you may have four reports beginning Thursday morning with the retail sales that may have a bit of a more positive bias. And we'll see, it's going to be very interesting at the end of next week. Will the U.S. economic data, if it's a positive one, begin to help the U.S. dollar as we're now starting the new third quarter of 2011? Will the positive economic data actually start helping the U.S. dollar on expectations that the Fed might consider tightening sooner rather than later? That is going to be a very interesting question, the answer to which, or at least clues to the answer, may be given to us towards the end of next week. So, we're running out of time, and I would like to thank you for joining me today. And also, I'd like to invite you to listen to my All Things Forex live daily broadcast Monday through Friday on allthingsforex.com, my website. And, of course, you can join me then and take a look and listen to my outlook on a daily basis as we follow along with the scenarios for the major currency pairs. We'll look at the market's reaction and discuss the currency majors. Thank you very much again to our friends from FX Street, and thank you all for the great questions. I'd like to remind you that I'll be here again next Sunday, so you're welcome to join us again, and I look forward to seeing you then. And before I finish, let me remind you that this program is intended for educational and informational purposes only, should not be considered as giving any buy, sell, or hold recommendations. Thank you all very much. I look forward to seeing you again next Sunday at 6 p.m. Eastern Time. Have a great week.